Section 6, management choices. This is the last main section. And what we do now, we're going to apply our knowledge to management shenanigans. Now, we're looking here, we're not assuming any ill intent on the part of company managers, but we're looking at their motivation and we're looking at the impact that choices they make can have on the numbers and on the ratios. So we're going to go through accounts receivable, inventory, property, plant and equipment, intangible assets, and leases, those 5, and we will see what the impact can be on management choices that are available to them. So first of all, provision for doubtful debts, and all of these I have mentioned briefly in an earlier section. So accounts receivable and provision for doubtful debt. If you remember earlier, we said that we're owed, let's say, $1,000 by each of 100 customers. So that's $100,000 receivable. And I said, are they all going to pay us? And the answer was, well, no, probably there will be a default. There'll be 1 or 2 defaults. Maybe some will argue, some will decide they don't want to pay us for whatever reason. And it's in business, it's simply going to happen. So what do we do about it? You need to say on as objective a level as possible, what is our honest opinion of how much of this 100,000 we're going to collect in? And if we think it's, let's say, 95,000, then you put through this provision for bad and doubtful debts. And what the provision is doing, it's going to be a cost in your income statement, and it's going to be a reduction to your accounts receivable. And so on your balance sheet diagram, it's going to be accounts receivable down and retained earnings down. So that's when we put in our provision. So accounts receivable drop, retained earnings drop by that amount. And the bigger the provision, the more the cost. The cost is going to be this year, obviously, because you're putting through a bigger expense through this year's income statement. So if you've got a high estimate, let's say 10%, that's being very prudent, very conservative. It's saying, I'm only assuming we're going to get in 90,000 of the 100,000. And of course, if you get more, that's very good, that's very profitable. That'll offset the cost that we put in. But if you, the assumption you're putting in is going to have a big expense now, because as you can see on the diagram, we are putting this big cost through the income statement, which affects retained earnings. So the impact of that is all your profitability ratios will be lower this year. Other ratios, your balance sheet is also going to be a bit lower. Your current ratio will be reduced because you've got less accounts receivable. If, on the other hand, we put in a very low estimate, this is called aggressive. Now, in most of these scenarios, you've got conservative versus aggressive. And aggressive is when managers are trying to make the business look bigger, better, stronger, more profitable, maybe more stable. Whereas conservative is you're being a bit more prudent, you're being more pessimistic. And you're not being pessimistic from a business perspective, it's pessimistic purely from an accounting perspective. So for example, by putting in a high provision here, 10%, it doesn't mean you're going to be happier to write off those debts and say to people, all right, don't bother paying us. This is only an accounting decision, not a business decision. But if you're making an aggressive assumption of 1%, then if more than 1% fail to pay, there are going to be additional costs in the future that we should have provided for. So if it turns out to be a couple of customers are not going to make the payment, then it means we're showing costs in the future that we should have shown last year. So if I'm only assuming 1% won't pay, then it is an aggressive assumption. I'm overstating this year's profit. This year's profit is higher than it should be. This year's assets are higher than it should be. So the current ratio is higher than it should be, and so on. 2, inventory. Now, we have different ways of accounting for the inventory flow through. There are 4 main systems that we can use. The 2 most common are LIFO and FIFO. Last in, first out, and first in, first out. Now, LIFO is actually only allowed in the US. It's not allowed under IFRS. So in most scenarios that you look at, it's going to be just FIFO. Now, I'll mention the other 2 briefly after I've described these 2. With LIFO, LIFO is saying the most recent purchases are going to be sold first. Let's imagine we have a bit of inflation. So it says we assume inflation here. If you don't have inflation, then all these descriptions have to be reversed. So let's say we have inflation. The most recent purchases we're making are the most expensive. Now, under LIFO, if you remember my description, you're buying items, you're throwing them in the shelf, and then you're picking them off the front. And so you're selling the most expensive items that we have in stock because they're the most recent purchases. And therefore, your COGS is slightly higher. You're showing a slightly higher cost of sales, therefore slightly lower profit. As a result of that, you're leaving old inventory at the back of the warehouse that may have been there for years. And so under LIFO, your profitability is lower than it should be, and your inventory on your balance sheet is lower than it should be because it's potentially many years old. The other method is FIFO, first in, first out. Here, think of it as a conveyor belt. Let's imagine we have days inventory on hand of about 180, so half a year, or we have inventory turnover of twice a year. So in this scenario, that you're buying inventory, you're converting it to finished goods, it's sitting in the warehouse, and then you're selling it after you bought, around 6 months after you bought the raw materials. So in that scenario, what you're selling is about 6 months old. So if you've got inflation, it's going to be 6 months inflation, 6 months price movement lower than under LIFO. And so your COGS is slightly lower, not much, but slightly lower, and therefore your profit is slightly too high. Now, that's on the income statement. On the balance sheet, because of the conveyor belt system, your balance sheet is up to date. Everything on your balance sheet has been bought in the last 6 months, and therefore your balance sheet is representing today's costs. So, in summary, what you've got, your LIFO, you've got slightly lower profit and slightly lower balance sheet. FIFO, you've got slightly higher profit and rather higher balance sheet. And management can choose which of these they want. I mean, as I said, LIFO you can do in the US, not many other places around the world. IFRS does not permit, so your international accounting standards do not permit LIFO. But if you're in the US, managers can choose which of these two. And you can see that depending on the flow through, depending on the inflation, you can tweak your profitability and your balance sheet by doing this. Now, I said there were 4 methods. One other method is called weighted average, which means I think of it as the bucket method. You've got everything you had at the start of the year, consider everything you bought, mix it all up in a big bucket, and then what you're selling, your COGS, and what you're not selling, your inventory, are at the same unit cost. Now, it's a much more complicated calculation, and you will find that your profit and your inventory are in between LIFO and FIFO. The 4th method, in fact, is invariably the most accurate, and it's called specific ID, specific identification, and that's where each item of inventory is tracked. So our cost of goods sold is the cost of that particular item. So for example, if we are a car dealer, if we're selling gemstones, anything that is low quantity, high value items, the specific ID method is going to be the most accurate because it's exactly tracking through on the COGS will be the actual costs of those items that we sold. And so that works in some industries. If you're a supermarket selling fresh produce, then it's going to be very difficult to put that one in place. 3, property, plant and equipment. This was one of the earlier examples we used. The example was we have a machine, we have a computer, it's going to last us for 2 years or it's going to last us for 4 years. Which one is correct? And of course, we don't know until a few years later. So we have different choices here. First of all, how do we depreciate? Are we going to depreciate straight line and say that we're going from the full value down to 0 evenly over its life? Or are we going to do this accelerated, where value drops faster in the earlier years and then tails off? Think about the value of a car. You buy a car, let's say you're paying £20,000 for a car. After you've driven it for a week, it's not worth, you've lost a lot of its value already. You've lost a very large percentage. And that would be accelerated depreciation if we want to reflect that in the accounts. how many years is the asset going to last? Long life, you may say this is going to last 10 years. Short life, you may say it's going to last 2 years. Again, short life, you're taking more cost earlier. Your depreciation is greater in the earlier years with accelerated depreciation or with short lives. But you've also got salvage value. How much salvage do we think we're going to get? Are we going to be recovering much for scrap? The prudent approach would always be to say, no, we don't expect salvage. But if we do expect salvage, then that will reduce the depreciation. So let's just draw how this looks. Here's net book value. So we have various choices. You've got, first of all, short versus long lives. And if you think about, so this is time, and you can see that effectively the gradient, the negative gradient, gives us the rate of depreciation. So how fast we're losing value. So you can see that short asset lives give you greater depreciation, but then later on, it gives you 0. Longer asset lives, you're being more aggressive. You're saying I'm taking less expense earlier on, but it continues for longer. The next choice is straight line versus accelerated. Here's straight line, here's accelerated. And you can see, again, that accelerated is your more conservative. You're taking more costs earlier and your value is dropping faster. Your straight line, you're taking fewer costs earlier and you're saying the value will drop by an equal amount each year. And then, of course, you've got salvage versus non-salvage. Let's say here's your straight line without salvage. If you said straight line with salvage, I think we're going to be receiving this amount at the end of the life, and you can see that that means you're going to have lower depreciation each year. So let's stick with that example for 1 second. Let's suppose we assume we're going to get salvage, and in fact we were wrong. What happens? What it means is when you make the sale, you're going to end up with a big loss. So let's say at the end we sell it and we get only that much salvage. Then had we assumed we were going to get that much salvage, that's going to be a big loss that suddenly hits the income statement. And think about the basic concept of accruals. When we defined accruals at the beginning of this course, it was very much, we're trying to allocate the cost of a good, we're trying to allocate the transaction to the appropriate time periods, the appropriate accounting periods. And when it comes to depreciation, we're trying to spread the cost of that asset out over the years over which we're deriving economic benefit from that asset. Now, if I'm assuming a great big salvage value, I'm underestimating those costs and therefore I'm overestimating the profits. You end up taking that great big expense in the last year that is not a representation of how the business generated benefits from that asset. So in that last diagram before the diagram disappeared, you can see that when you're assuming a lot of salvage, you're deferring the cost and it's not a fair representation of the accrual. We're not accruing the costs evenly in an appropriate way. So there you go. You've got the aggressive assumptions are straight line, because you're in a straight line long life with salvage, and in all 3 cases you're taking lower expenses today, you're reducing depreciation, increasing profitability and increasing your asset values. And then your defensive or conservative assumptions are accelerated, shorter lives and no salvage value. Number 4, capitalization or expensing. Now, we're talking here about intangible assets. Now, you could also apply this to other tangible assets, but let's stick with intangible assets. So let's say we create, so Quartic, we create a training course like I'm doing here, sitting in front of our recording studio, sitting in the recording studio. What's the difference between capitalizing and expensing those costs? So capitalizing is saying I'm creating an asset. The cost of this course is the everything to do with the equipment, any rent involved, any salary costs, all other costs to do with creating this course is part of that course, will be capitalized, it'll go onto the Quartic balance sheet and then gradually amortized or depreciated over a number of years. The alternative is we're expensing it. So I'm using existing equipment, there's no extra rent to pay, there's no extra salary to pay, and therefore just treat all the costs as expensed. It goes through this year's income statement, and so it doesn't appear on the balance sheet, and therefore, although that may be more conservative, we're then generating benefits in the future without the respective costs. So if we capitalize, we're deferring the costs so that we are maybe more appropriately matching the revenues with those costs. So we're matching the revenues from selling the course with the costs of producing the course. That's capitalizing it. You put the costs on the balance sheet and you gradually amortize them to get that matching the accrual. If you expense it, you're putting it all through this year's income statement. So this year's P&L will be lower than it should be because we have all the costs of creating this course, but not many revenues yet. And therefore, the revenues will benefit future accounting periods, but the costs are a negative adjustment for this year's accounting period, this year's accounts. And so you can see we're trying to match the two. So the choice, if we capitalize and amortize, you're increasing the assets, you're deferring the expense. This year's profits are much higher because salaries and other costs of producing the course are deferred. They're not put through this year's income statement. But in the future, you will get those additional costs as we amortize it. The cash flow reduces CFI. In other words, the cost of producing the course is treated as an investment. So we are creating an asset. So for example, the salary cost should be a negative CFI. It's the investing cash flow. On the other hand, if we expense it, then it all goes through CFO. It means this year's income statement is lower, but in the future, you're going to have a higher profit because you're not seeing the amortization. And if we expense it, everything goes through CFO as an operating cost of salaries, operating cost of rent, and so on. And therefore, the expensing option reduces CFO. CFO will be lower than were we to capitalize it. Now, I said near the beginning that on your income statement, you have lots of choices, and management choices can have a big impact on the profitability of the business. What I also said was that the cash flow statement is much more objective, but there are still tweaks we can make. Here's an example of a tweak. If we expense the costs of producing the course, then all those costs go through CFO, and so CFO is lower and CFI hasn't been affected. If we capitalize, all those costs go through CFI, so CFI is lower and CFO hasn't been affected. So although you can't change the amount of money in the bank through that accounting decision, you can change how the cash flow statement looks to a small extent. And here's one of those examples. Finally, operating and finance leases. Now, the way leases are accounted for, we need to define which of two different methods we're going to use. Now, first of all, let's think about what a lease is. We are using a machine. Let's say I have my computer, doesn't belong to us, we're getting it from a shop, and what we agreed with the shop is we would pay monthly installments for 4 years. Now, an operating lease is, roughly speaking, I have the right to cancel that, I can upgrade it, it goes wrong, I send it back to the shop, and so on. So I really don't own it, it doesn't look like I own it, and I'm paying a monthly rent. A finance lease or a capital lease, capital is the US term, finance is the IFRS term. So a finance lease is, although I don't technically own the machine, no one else is going to use it after I'm finished with it because I give it pretty heavy usage. I'm committed to paying monthly installments for 4 years. At the end of 4 years, the machine is worthless. There may be an option for me to buy it for £5 at the end because really otherwise they're just going to be putting it on the scrap heap. So that's an example of a finance lease. Now there are exact definitions which I'm not going to go through now, but if managers have a choice, they are usually going to prefer the operating lease, because if you say this is an operating lease, then the costs go through CFI, the expenses go through the income statement, but the main thing is there's no asset on the balance sheet. Now you may think, don't we want lots of assets on the balance sheet? Well, sometimes yes, sometimes no. But the main thing is there's no liability either. Liabilities generally are not good on the balance sheet. You don't want lots of debt appearing. Now, if we have a finance lease, that's where we're committed for 4 years in my example, then because we have that commitment, you have to show the liability. So think what liabilities are. They're things that are going to have to be paid. And if I'm committed to 4 years of lease payments, then at the end of the first year, I still need to show the remaining 3 years of liabilities. And so the way this works in accounting terms, with an operating lease, the lessee, that's me, that's the person using the asset, as opposed to the lessor that owns the asset and has granted another company the usage of it. So the lessee who's using the asset, they are simply paying rent, showing the expense, and that's the end of it. Whereas with a finance lease, the lessee, because the substance of the transaction is, well, in fact, they are the only people that are ever going to be using this asset, it looks like they have bought the asset using financing. And so with a finance lease, the lessee, the company using the asset, they will show the asset on the balance sheet under PP&E, and they will show the liability on the balance sheet as a finance liability. It's the lease liability. And assets go up, liabilities go up. So let's say the present value of all the payments I'm going to be paying is £1,000, then my assets will go up by 1,000 and my liabilities will also go up by 1,000. And in general terms, that makes my balance sheet look less healthy. There's more risk, there's more liabilities, and in general terms, more liabilities are bad news. So for the most part, companies prefer operating leases. So you can see the accounting treatment here. Lease payments are treated as a regular operating expense, and in the income statement and CFO in the cash flow statement. There's nothing on the balance sheet. With a finance lease, it goes on in full as an asset, even though we don't legally own it, because the substance is that we're the only people that are going to use it, and therefore we show it as if we own it. And then the liability. So it's as if we bought this machine with 100% debt finance, and all that debt is going to be shown on the balance sheet as well. Then a lot of the cash payments, in fact, are CFF, because you owe a lot of money, and your yearly or your monthly or your quarterly cash payments, there'll be a bit of interest in there, but most of it is actually paying off your liability, and that's CFF. So in terms of your balance sheet, operating lease, lower assets, lower liabilities. Finance lease, you're showing the asset and you're showing the liability. In terms of your cash flow statement, operating lease, it's just your CFO, you're paying CFO, negative CFO. Finance lease, a bit of CFO for the interest component, but most of it's CFF. You're paying down the financing. And in terms of the income statement, your operating lease, it's the lease expense under operating expenses. For a finance lease, you've actually got depreciation and you've got interest as well. So very different components in your financial statements. Now, the rules for operating finances leases are in the process of being updated, which is actually making them a little bit closer together. But again, that's not a topic for today. The main point of this is, are we trying to avoid having those liabilities on the balance sheet by using an operating lease, or are we showing the asset and the accompanying liability with a finance lease? So that gives us a good view of what managers may be trying to generate. You can see in those examples, there are choices. And if managers are given an incentive, for example, they may get a bonus if it's more profitable, you can see there are ways of tweaking the assumptions in order to achieve their objectives. So in this sense, we can say that the accounts may be less useful, even if they're still within GAAP, they're still compliant with the rules. If managers have made decisions that distort some of the numbers for their own benefits, then it may make the numbers less useful, even if they're still technically within the rules. Various other examples that we haven't looked at in any detail, moving items up and down the income statement. So, for example, non-operating income as revenue. Now, when we first looked at the income statement, remember I said you want to make anything positive as high up as possible, anything negative as far down as possible, because they will make the profit figures look better. So non-operating income as revenue, pushing it up the income statement. Large expense items as unusual or infrequent, because that's all the way down just before EBIT. Deferring expenses or bringing forward revenue. So for example, long depreciation lives, that's an example of deferring expenses, or bringing forward revenue. Somehow if we show revenue that maybe we shouldn't have shown, that's making this year look better. Now, there may be incentives the other way around as well, deferring revenue or bringing forward expenses. This is called cookie jar accounting, and a company called Sunbeam did this before they got into huge trouble. And the idea of cookie jar accounting is the company is saying, we've done really well, let's put some cookies in the jar. So we've done really well this year, we don't think we're going to do as well next year, let's defer some revenue, or let's bring forward some costs, make this year's income statement look a bit worse, because that means we'll get the benefits next year. For example, let's increase the provision for doubtful debts. Let's turn it from 1% to 10% this year. Big expense this year, reduce this year's profit. Next year we say, oh, in fact, we didn't need it. We did much better than that, and you reverse the expense. It makes next year look much healthier. Hiding liabilities, operating leases. There is a liability implicit, but they're not shown. That's actually where the accounting standards are changing. But overall, if you can have liabilities that are not shown on the balance sheet, then fantastic. It means you've gained access to assets without having to show how you're paying for them. Using non-GAAP profit measures when publishing results. A classic example of this was the company Groupon. Now, Groupon had their initial public offering a good few years ago now, and what they did is they said, we're going to be publishing our own version of profits, and their own version of profits excluded, well, to be blunt, most of the expenses. They said all the costs we're spending on advertising is actually building up a customer base, and so they almost treated that as capitalizing those expenses. I mean, that's something WorldCom did before they collapsed. That's another shenanigan. But what Groupon did, they said, here's our definition of profit. And when they did their filing with the US regulator, the Securities and Exchange Commission, the filing said, on our adjusted basis, we're making profit of a couple of $100 million a year. Now, the SEC turned around and said, you must be joking. This is not a GAAP profit figure. You have bulldozed your way through the accounting standards and said, here's the number that we like, go and change it. And what happened is they had to restate their numbers, and instead of a couple of $100 million of profits, they had a couple of $100 million of losses, which actually much more accurately reflected the expenses they were incurring. So that's a non-GAAP profit measure, and you'll find that all sorts of industries do play that game. So look for these red flags. Sometimes it can be quite fun. If you know what sort of shenanigans can arise, then looking for these can actually make it quite an interesting exercise, because when you find them, not only do you get a much better view of what the company is doing, but it gives you that advantage over other analysts, and maybe it helps you to buy some shares or not buy some shares because you've got a better view on the valuation of this. And all this comes from understanding the accounting rules, understand how to interpret your balance sheet, your income statement, and your cash flow statement. And although the amount of knowledge you can gain, the amount of analytical skills you can pick up is huge. I mean, you come back for CFA Level 1, CFA Level 2, and there are plenty of other courses that you can go on. The basic knowledge that you've gained will give you the ability to do a lot of this analysis. Section 7, conclusion. We've gone through what the accounts are. We've done the basic concepts. We've looked at how they work in detail, how they interact. We did a worked example, we did ratio analysis, and then we looked at management choices. All there is to say here is we've covered such a wide range. It hasn't been a particularly long course. We've done it from the beginning. And as I said, there are many more courses we can go on to get our understanding a lot more detailed. There are plenty of extremely complex accounting areas that we haven't touched on, but already we have a decent understanding of the basics. Hopefully now we have demystified what the accounts are all about. you can open up a financial report, look at the main financial statements, and instead of just falling off your seat with shock at how many numbers there are and what all these strange words, hopefully you now understand a lot of the words and you can interpret a lot of the numbers that we've now described. So it's a good starting point. Do not go away and think you're now an expert analyst, but you do now have a very good starting point to be able to go forward, do lots more learning, and apply these skills in your everyday life. Thank you very much indeed.